The U.S. industrial real estate market continued to gain momentum during the third quarter, with all the key leasing metrics we track showing improvement from the second quarter. We saw around 60 million square feet of positive net absorption nationwide for the quarter, with 59 of the 60 markets tracked by CBRE in positive territory for the quarter. The U.S. availability rate fell 20 basis points to its lowest point in 6 years. The national net average asking rent inched up to its highest point since 2009, and new supply additions reached the 30 million square foot mark for the first time in 5 years. On the capital markets front, transaction volume was down 13% compared to Q3 2013, largely due to a drop-off in portfolio and entity-level trades, though cap rates remained stable, and the average price per square foot was up 17% year over year. Secondary markets continue to set pace for the national industrial market, with Austin, Fort Lauderdale, and Tucson posting the largest declines in availability. The major markets also continue to tighten. Among the top 10 markets, Inland Empire and Central New Jersey were the only two markets that did not see a decrease in availability. Rent growth is also widespread, with the rents rising quarter over quarter in almost 60% of the CBRE tracked markets. Western markets saw the sharpest increase in rents, led by San Jose, Tucson, Seattle, and Denver. E-commerce companies continued to drive demand in many markets across the U.S. and were noticeably active in Dallas-Fort Worth and northern New Jersey during the third quarter. The e-commerce boom is supporting the growth of third-party logistics firms, or 3PLs, which are expanding their footprints in inland port markets like Chicago and major coastal ports like Miami. The domestic energy revolution is also playing a large role in the industrial sector, especially in Denver and Houston. The outlook for the U.S. industrial market is healthy, as fundamentals are expected to keep improving in line with the U.S. economic expansion. In 2015, we expect to record the 5th straight year of positive net absorption and the 4th consecutive year of declines in availability and growth in rents. Development activity will still remain below pre-recession levels, but gain steam, particularly in secondary markets. In the third quarter, 61% of CBRE tracked markets reported an increase in completions. One key trend to watch heading into 2015 is the ripple effect of the expanded Panama Canal. The widening of the canal, set to be completed in 2016, will likely translate into greater demand for industrial facilities near ports, as firms will need more space to process shipments arriving on post-Panamax ships, which are more than twice the size of ships passing through the canal today.